As you probably know by now, what we try to do to start with is give you a little bit of an update on mortgage rates and what the bond market is doing. So we'll jump right into that. In that regard, here's our current rate grid on our website. It's been updated to reflect current conditions. We're barely hanging on to the sixes at this point. It's been creeping up. In fact, a lot of news outlets are already talking about mortgages are in the sevens. That may be true with a lot of lenders. I've still got some conforming loans, government loans, as well as even Fannie, Freddie 30-year fixed conforming, where I can still get people a little bit under seven, like 6 and 7/8, depending on the parameters. And that the current situation in terms of rates can be seen by looking at the 10-year bond yield chart. As you know, we typically put this up for the past 5 business days. So this goes back to last Friday to current. And unfortunately, as you can see there, the trend has been upward. Back a week ago, last Friday, we were down lower, 4.1 or less. In fact, not too long before that, we're actually closer to 4. So we have seen some yields go up on the 10-year bond, which, as you know, I've suggested many times is your best benchmark to track mortgage rates and which direction they're going in. So what is going on now to drive these yields up? Well, it's all about, it starts with last Friday. As you may recall, in last week's program, we had talked about the inflation numbers were released last week. And last Friday, the day after our last program, was the release of the PPI, the Producer Price Index. That's inflation at a wholesale level. And last Friday, it came out at 0.3, which was actually higher than forecast. The forecast was 0.2. And it was only 0.1 in June. So this definitely spooked the market because of the increase in yield that was not forecasted. And so unfortunately, that created a little bit more concern that maybe inflation's not under control as much as we had hoped. And then the other big data point that came out this week was retail sales. And retail sales was forecast to be a 0.4% increase. Well, guess what? It turned out to be 0.7%, so quite a bit higher than forecast. So between the PPI last Friday, the retail sales earlier this week, I think that was released on Tuesday, some strong indicators, both that inflation's not entirely under control and the fact that retail sales appear to be strong. That's, you would normally think that's good news, right? That's a good indication that the economy is doing well. Well, as I've said before, several times actually, when it comes to the mortgage market and mortgage rates, unfortunately, we can sometimes be in a situation where what appears to be good news is actually bad news. And this week is a good example of that. Higher retail sales, while you might think that's good news, that means the economy is healthy and strong. In that regard, it's kind of bad news because it spooks the bond market. It spooks bond traders. It spooks folks who are trading in mortgages. And that's caused the increase in yields this week. And this was exacerbated actually yesterday when the minutes of the last Fed meeting in late July were released. And in those minutes, that detail, there was a lot of commentary among the Fed governors about inflation not being totally controlled. And as a consequence, there is now a lesser probability expected that the Fed is going to pause on their strategy of raising the Fed funds rate to control inflation. Now, we're about a month away from the next Fed meeting. But again, the concern is that, after the last meeting, the expectation was pretty good chance the Fed's going to pause. Now, with these stronger numbers that have come out, less of a belief that the Fed is going to pause, and that's what's driving the bond yields up. And yet, with that occurring, there's also a little bit of a mixed signals again, because today the leading economic indicators number came out, and it was declined by 0.4 in July. That's the 16th month of the leading economic indicators index dropping. So that would, of course, suggest the economy is slowing down, and who knows, we may end up in a moderate or mild recession. So it's hard to tell given these mixed signals. And of course, we still have an inverted yield curve where the 2-year bond yield is higher than the 10-year bond yield, although that spread, frankly, is a little bit narrower, but still inverted, which we've talked before, how inverted yield curves usually are a signal that we are going to see a recession at some point. So we'll see how that plays out. And in that regard, while I may be with this news giving you some gloom and doom, I want to go now into showing you some numbers as it relates to forecasts of mortgage rates, both where they're going to be at the end of this year, as well as where they're going to be at the end of 2024. So what to expect for mortgage rates next year as it relates to the housing market. Well, what you're going to see on this slide is on the left side of the slide, you're going to see a list of several different market observers, if you will. These are different organizations like the Mortgage Bankers Association, National Association of Realtors, Fannie Mae, Morgan Stanley, et cetera. Now, all of these entities, all these firms are certainly firms that are very expert, very tuned in to what's going on in the financial markets. And so what I'm going to show you now is basically a summary of what they're predicting, these different firms are predicting for late this year in 2024. And it's kind of interesting. As it relates to quarter four of this year, quarter four will be October 1 through December 31. For quarter four 2023, these 8 firms, these 8 research firms, in aggregate, they're forecasting a range of mortgage rates at the end of the year from 5.9 to 6.6, depending on which firm we're looking at. So that's the range forecast for the end of this year, 5.9 to 6.6 on a conforming mortgage rate. The average of that, of those predictions of that range, is about a 6.62%, 6.26% average. So not bad. So this group of 8 research firms is forecasting will be somewhere around 6.25 by the end of the year, which of course we were at that level earlier this year. Doesn't look like we are now. Obviously, we're close to 7. But again, these firms are forecasting by the end of the year, this will settle down. We might be closer to 6.25. Now, what's really interesting is when you look at what are these firms predicting for quarter four 2024. And with that, it's interesting because the forecast range is encouraging. For one, the range runs from a low of 4.90 to a high of 6.10. So if you take an average of that range with these 8 research firms, and the average forecast for the end of 2024 is 5.72. That's pretty good. And that would certainly be helpful in terms of getting the housing market back on track a little bit. What's interesting, though, I will point out, is we were actually at a 5.72 rate on a conforming mortgage early this year. I mentioned it at the time when I suggested you should not try to time the market. So we've had one opportunity already during calendar 2023 where mortgage rates, conforming mortgage rates, were under 6. They were in the mid to high 5s, right in that 5.75 range. So let's hope that by end of next year, we'll be back to that range or better. So with this, I just wanted to give you some hopeful news that despite the current conditions, and particularly the run-up we've seen in yields and mortgage rates this past week, there is still forecasts that suggest we're going to see better rates in the next year, year and a half. So keep that in mind. We'll keep a close eye on that, and we'll see if those predictions turn out to be true. I actually think that they will tend to be pretty accurate once we get into these quarters that are shown there. Okay, so again, that's the mortgage rate outlook for right now. I want to shift now to a different topic. As you know, I try to keep up on the news feeds for the financial markets. And a headline caught my eye that I just had to look into and read the article and see what was really going on there. And you can see right here on the slide, the article says, Dave Ramsey, mortgage hack could save you hundreds of thousands of dollars. Well, you probably all know who Dave Ramsey is. He's a financial advisor, educator. He seems to be in the news a lot. I see a lot of articles and headlines referencing his name and with his financial advice for families and so forth. And so when I saw this mortgage hack that's been named after Dave Ramsey, I had to look into it. And so what did I find? Well, the article was describing that according to Dave Ramsey, this mortgage hack is part of a strategy to get to a debt-free situation on your home so that you can invest the funds elsewhere. And so, of course, with the article opening with that as the basis or the premise of this mortgage hack strategy, it then got into the specific of what the hack is. Well, as I kind of anticipated, and of course, it'll show here on the slide, the drum roll, the mortgage hack by Dave Ramsey is actually nothing more than just pay extra on your mortgage loan, which of course I got a chuckle out of that because that's really not new information. It got me thinking, how the heck did Dave Ramsey end up getting this idea, this strategy named after him as a mortgage hack? Because frankly, folks, this is not a new strategy. It's not a new idea. This strategy was around before Dave Ramsey was ever heard of. And so what were the details of paying extra on your loan? Pretty simple. One is simply pay extra principal when you make your payment every month. Again, not a new idea. Why it's being called a mortgage hack, I'm not sure I understand, but that's not a new idea. That's something that people have always had the ability to do. And, a lot of smart homeowners do look at that as a way to try to reduce their loan balance more quickly and build more equity. The other idea in this mortgage hack by Dave Ramsey, the other idea or strategy was mentioned, was the biweekly payment schedule, which of course I just covered that in our program here a week or two ago and pointed out how you can achieve the same result without not actually signing up for a biweekly schedule with your loan servicer. So again, I got a chuckle out of the fact that those were the brilliant new mortgage hacks named after Dave Ramsey to save you hundreds of thousands of dollars on your loan. Well, by the way, on that headline, saving hundreds of thousands of dollars is definitely an overstatement because, of course, most mortgage loans are, some number of hundreds of thousands, 300, 400, 500. So the idea you're going to save a good chunk of your overall mortgage from this strategy is a little bit probably overstated. And in that regard, I want to give you a couple of what I call inconvenient truths about the basis of this article. And that is, it's having to do with mortgage length. And what I'm referring to there is not the term, like a 30-year term or a 20-year term or a 15-year term. What I'm talking about there is mortgage length is what is the average life or length of a mortgage after it's been obtained. Well, guess what? The average mortgage length in the U.S. is less than 10 years. That's right. So what that means is after a homeowner gets a mortgage to buy a house, or a homeowner who already owns, of course, a home and has a mortgage and they're refinancing, after they get that loan, the average length of that loan, in other words, or another way to put it, the average life of that loan is going to be less than 10 years. And then the other thing to know as it relates to a purchase transaction, when a buyer buys a home and finances that purchase, they expect to stay in that home for a median of about 12 years. So when you consider these two data points, what you realize is the notion of pursuing the quote unquote Dave Ramsey mortgage hack to pay extra on your mortgage to achieve a free and clear home so you can invest your funds elsewhere. A very, very high percentage of situations are going to be such, well, you'll never achieve that destination because you won't have the mortgage for that long to start with. People keeping their people keeping their mortgages for 30 years, and actually their homes too, for 30 years is not that common anymore. So in that regard, am I suggesting that paying extra on your mortgage is a bad idea? Not at all. But what I would suggest is that you need to realize that if you're going to decide to apply more dollars to pay down your mortgage quickly, understand that you're making an investment decision. In other words, you're deciding to take those extra dollars and apply it to your mortgage, which of course is secured by your home. So that is an asset. So essentially what you're doing is taking extra dollars and investing those extra dollars into your asset, your home, by paying down your mortgage debt faster. That's in itself not a bad idea. And in fact, to that degree, if you've got a mortgage rate of 3% and you're paying extra on that mortgage, you're essentially earning a 3% return by reducing that 3% debt balance. But therefore, again, understand that paying extra on your mortgage really should be considered as an option relative to how else can those extra dollars that you're going to apply toward that mortgage, how that can be used. Is there a better investment option than simply applying it toward your mortgage, toward your home as an asset to speed up the reduction in the balance and creating more equity? Depending on the scenario, like as we entered 2008 and beyond, that would have in hindsight turned out to be considered a poor strategy only because property values fell. So you just want to keep that in mind when you're considering this Dave Ramsey mortgage hack of paying extra on your mortgage. So I wanted to cover that just to kind of clear up a little bit of the information that was the premise of this article. I think it's a little bit more complicated decision point than this article would suggest. And the destination point, I think, in most cases will never occur. Okay, now I'm going to go ahead and move on. You may remember in the program the last couple of weeks, I've talked about mortgage insurance, both PMI, that's private mortgage insurance, which is mortgage insurance that is put on conforming loans, conventional conforming loans. That's loans not insured or guaranteed by the federal government. And then there's also FHA mortgage insurance. So this week, what I want to talk about is how do you cancel your mortgage insurance after you get a mortgage that has mortgage insurance on it? Well, the first thing to understand is it's going to differ depending on whether you have a conventional loan or an FHA loan. And so what I'm going to first cover is for a conventional loan. And in that regard, I'm going to be covering the basic parameters for canceling your mortgage insurance on a conventional conforming loan. That would be a loan that's owned by Fannie Mae or Freddie Mac. And in that regard, canceling your mortgage insurance or PMI depends on two different approaches. In other words, you can cancel your PMI coverage based on original value of the home. What does that mean? Well, canceling the PMI using the original value means the original value when you got the loan. In other words, if you bought the home, then that's your purchase price or your appraised value, whichever is lower of the two, your recorded price when you bought the home. Or if you refinance the loan and it has PMI on it, then what the home appraised for at the time the loan was obtained. So if you're looking to cancel your PMI and you're going to use the original value of the home to do that, then what has to happen is the date of the mortgage balance is scheduled to reach 80% of the value via normal amortization. And by the way, you have to submit a written request first. So the idea is if you want to cancel your mortgage insurance based on original value, you have to wait until the mortgage balance is scheduled to reach that 80% level based on the original value at the time the loan was obtained. And that's through normal amortization. Well, to put that more simply, what that means is if you got the loan with 5% down, that's a 95% loan. And through normal amortization, how long is it going to take based on the original value of the home to get down to 80% of that original value just from making your normal payment? It's going to take over 6 years. So just understand that by trying to cancel PMI using your original value, it's going to take a while because you have to wait until that amortization has occurred to bring the mortgage balance down to 80% of your original purchase value. Or if you want to try to reduce or remove the PMI before that, in other words, you want to reduce or eliminate the PMI on a date before that amortization period, 6 years from now, then it's a case of you're going to still look for 80% of original value, but you're going to have to pay down that balance in order to get to the 80% before your request is going to be approved. So that's based on using original value, which, by the way, is probably not the most common way people try to cancel their PMI. The more common way is to cancel your PMI using your home's current value. What that means is you're trying to cancel your PMI by taking advantage of the fact that your home has grown in value, your market value has increased. So that is another way you can cancel your PMI, and a lot of times more quickly. Again, you have to submit a written request. More importantly, the loan does have to be seasoned for at least 24 months. So you've got to have the loan for at least 2 years, and you've got to maintain an acceptable payment history. So if you got your mortgage, you put a minimum down, you've got PMI, and you want to try to eliminate that PMI as quickly as possible, you can do that using your current home value based on this criteria. And it's also going to depend on how long after you got that loan that you're going to try to request the cancellation. If you're going to try to request the cancellation, again, after a minimum of 2 years, but prior to 5 years, then the loan to value has to be at 75%. So in other words, your loan balance has to be 75% of the market value. Now, if you're going to be making this request more than 5 years from when you got the loan, but again, at least 2 years after you got the loan, then you only have to establish that your current loan balance is 80% of your current market value. And of course, how to either one of these levels, 75% of value or 80% of value determined, you have to obtain an appraisal by a state licensed appraiser and submit that to the lender with your request. So again, bought a home the last, let's say 3 years ago, you may be able to get PMI canceled in that period of time if you can show you have at least 75% of equity. 25% of equity, because your loan balance is now 75% of market value. And again, if it's over 5 years, you only have to prove that your loan balance is at least 80% of market value or less, and you can get the PMI dropped. So it's actually pretty simple. These are the parameters to do it. Keep it in mind. If you're thinking about doing this, definitely pursue it. I would suggest beware of any mortgage originator who suggests the way to get rid of your PMI is just to refinance the loan. If you meet this criteria, you don't have to refinance the loan. And of course, you're not going to want to. If you're in the 2s or 3s, you have PMI, you should be focused on how to cancel PMI as quickly as you can based on these parameters. Now, what's the case with FHA? Well, FHA is a whole different story. With FHA, you first have to realize is that FHA mortgage insurance has two components: the upfront mortgage insurance premium, which was 1.75% of your base loan amount and financed into your loan amount, as well as the annual mortgage insurance premium that's paid monthly as part of your mortgage payment. Well, the upfront MIP portion can only be refunded if you're doing a refinance into another FHA loan. And you can only get a refund during the first 3 years after you got the loan that's being refinanced. And the amount of refund drops pretty quickly. It's only 80% of your upfront premium in the first month after you got the loan. It drops to only 10% of the upfront premium at the 36th month after you got the loan. And again, the only way you can get a refund in this range at all is if you're refinancing into a new FHA loan within the first 3 years. After that, there is no refund of the upfront premium at all. It's sunk cost. The money's gone. You won't be able to get any of it back. Now, as to the annual mortgage insurance, that is going to be a life of loan cost if you put less than 10% down when you got the FHA loan. So again, if you put 3.5% down, 5% down, anything less than 10% down, the annual mortgage insurance, which is going to range from 0.50 to 0.55, that's going to be in place for the life of the loan, unless you've put at least 10% down. Then if you did put 10% down, the loan, the annual mortgage insurance, the annual MIP will be removed after 11 years. And again, that's pretty much automatic. Again, if your loan to value at the time you got your loan was 90% or less, then after 11 years, your annual FHA mortgage insurance will be canceled. And that's essentially done on an automatic basis. So in that regard, it's obvious that conventional PMI is easier to cancel. And if you're a very high credit score borrower and you're looking at an FHA loan or a conventional loan, from a perspective of mortgage insurance, a lot of times it may be better to go conventional, only because you'll have that opportunity to cancel that PMI in a relatively short period of time compared to the FHA option. So again, those are the ways you can cancel a mortgage insurance on a conventional or FHA loan. Again, if you have any follow-up questions, feel free to contact me and I'll help walk you through it. Now, with that, I'm going to go ahead and go into our closing question from last week. And this is one I actually run into fairly often. And the question was, is there a minimum distance a borrower must relocate before a second FHA loan can be obtained? What this is really having to do with is a case where a homeowner's got an FHA loan, they're in a home they're living in, and they decide they're going to purchase another home, and they're interested in maybe using FHA again to purchase that other home. Is that going to be allowed? Yes, the answer is yes, it is possible. However, there are some pretty specific restrictions or conditions in order to do that, which does eliminate a lot of scenarios where people will try to get another FHA loan when they own a home that has an FHA loan on it now. And the whole idea is Again, they're trying to get another FHA loan while they own a home that has an FHA loan currently. Well, the first and biggest requirement is the borrower must be relocating or has relocated for an employment-related reason. So in other words, if you're, to use my market here, if you've got an FHA loan in Palm Springs and you decide you want to buy a home in Indio and also use an FHA loan, and you're going to keep the home in Palm Springs that has an FHA loan, not allowed. Why? Because, well, chances are it's not being done for employment-related reasons. And more importantly, and this is the other main criteria, is the new home that you're going to try to obtain using an FHA loan while keeping the home you currently live in that has the FHA loan, is the new home has to be at least 100 miles away. If it's less than 100 miles, if it's in the same market, you can't get another FHA loan with a minimum down payment when you already own a home with an FHA loan in the same market. So the idea here is, in order to get a second FHA loan with a minimum down payment while keeping your existing home with an FHA loan, it essentially is going to be allowed if you're getting relocated for a job purpose and the relocation is at least 100 miles away. If you try to buy something that's within the same market with an FHA loan, the restriction also is you can't get a minimum down payment. You're going to have to put 15% down, which of course discourages most folks in that particular scenario. Now, here's what's really interesting. Let's say you do have to relocate more than 100 miles away and you buy a home in that market and you get an FHA loan with a minimum down. And then a year or two later, and you still own that home where you originally lived with an FHA loan. Then a year or two later, you get relocated again, maybe back to the original market you lived in. Would you then be able to buy another home with a minimum down FHA loan in that same market where you already own an existing home that has an FHA loan? Yeah, you can, but you have to meet the same criteria regarding relocation for an employment-related reason and the 100-mile away rule. In this case, it'd be 100 miles away from where you moved to for the first relocation, and then the second relocation, you're being moved more than 100 miles away and happen to be going back to the original market you lived in. A little complicated, but it is possible. This is the way you can get it done. So with that, I'm going to go ahead and go into our closing question for next week. And again, it's a topic we run into quite a bit. So here's the question. What are the requirements for a home buyer who wants to use gift funds for their down payment and closing costs? The rules are relatively straightforward, but there is some pretty specific information and parameters that are required. And it does vary a little bit depending on whether we're talking a conventional loan or a government loan like an FHA, VA, et cetera. So tune in next week where I'll give you the information and the answers for this question, and it'll be on the house.
Well, as I said at the very beginning, Art is the wizard of mortgages. And if you have questions about this, first of all, hey, don't time it. It's, it's like trying to catch falling knives. Hire an expert. Call Art at 760-883-5700. That's his office number. And of course, you can call him on his cell at 74612-9035. Yes, for those of you asking, he will take that while he's on the golf course. And his website is mwloan.com. Art at mwloan.com is email address. I just want to also make sure that you understand Art is only out on the golf course because he's helping get documents signed for someone taking new loans. So he's not out working on his backswing or his putting stroke because he is always working. Art, any last thoughts before we wrap up today's show?
No, just first of all, I'm not a golfer. So if I'm going to apply a lot of work to anything, I probably should apply it to my golf game, but I don't have time for that. It's been a tough week, but keep the faith. I think we'll be okay. Equity lending is still very strong. In fact, maybe more so as mortgage rates, go up a little bit more here. I think homeowners are going to be more convinced to stay put, maybe try to spend some of their equity, try to improve their home. So keep that in mind. Yes, we love little loans. So if you're looking for a break in your mortgage rates and you need a small loan, there is an opportunity. The industry is definitely focused on giving folks who need smaller loans a better deal. So if you're in that category, please contact me and I can give you the numbers. So with that, I appreciate everyone being here. Thank you for watching and listening. And just remember, I'm Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. Take care.